welcome back to the channel. My name is Jane. Welcome to Spicy Sunday Finance. Today, we're going to be talking about investing and how to start investing if you have never invested before. This is going to be your ultimate beginner investing guide. So buckle your seatbelts. This is going to be a super long video, but it's going to contain a lot of information because this is the video that you will need to watch from beginning to end if you are really serious about learning a life skill called investing. So investing is something that the earlier you start, the better you're just going to get out of it from, because the longer time that you have in the market, later down in life, you're going to thank yourself. So we have 8 timestamps today. I just have my computer right in front of me. So if I'm looking down, that's where I'm looking. But if you want to go to a certain timestamp, you can check the description down below. But today we're going to be talking about why is investing so important? How does the stock market work? Because I think that's the part where a lot of beginners or people just starting out are kind of skeptical about. So we'll go into that. What are stocks and ETFs? How do you actually invest your money? What are some red flags to avoid? Should you research into companies? And then what's next? How do you build a routine? And then lastly, we're going to go through everything that we've talked about, and we're going to plug these numbers into a calculator so that you can really see the tangible, actual numbers to feel and get motivated from. Because usually when I see numbers, I get more inspired to actually kickstart my journey in anything, because the numbers, they don't lie. So let's go through all of that and get your investing journey started, because it is never too late. So to share a little bit about myself, I started investing when I turned 20 years old. In BC, so in the province of BC in Canada, you can't start actually putting your money into an TFSA, RSP, FHSA, which these are called registered accounts. They're registered because they're registered with the government so that they can keep track of all your deposits. That way you can take advantages of the tax benefits and tax deferrals and tax advantages that come with these registered accounts. Now in BC, you can't start until you turn 19. In other provinces, you can start when you turn 18, but in BC, if you have turned 19, you'll have the amount that was accumulated the year before. So for example, say if you have turned 18 in 2025 this year, the TFSA limit that was introduced was 7,000. So as an 18-year-old in those provinces, you have an amount open for 7,000 that you can start contributing into your TFSA. Whereas if you're in BC, even if you turned 18, you can't open the account yet, but you'll have that room available for next year. So next year, say if the government allots another 7,000 as a new contribution amount, you will now have 14,000 as a 19-year-old in BC that you can start putting money into your TFSA and open the account. So I started when I was 20 because as a skeptical girl myself, as a lazy girl myself, sometimes I was a little scared until I realized that it's actually not that hard and it's not too bad. And thanks to a wonderful platform called Wealthsimple, I got to start pretty early on and got to see compound interest really grow and kickstart for 7 years. So that is why it's important to start investing as early as possible. And another reason why I wanted to create personal finance content specifically on investing, so that you can really see the advantages and benefits at an early age. So if you are in Canada or in any country and you are now eligible to open up an investing account, this video is definitely for you. So although saving is nice, and if at an early age your parents have got you to save money set aside in a savings account, that is great. That habit is going to get you really far. But in Canada, at least, the highest savings or high interest savings account usually comes at around 3%. Inflation is the reason why we invest. Inflation in Canada is usually around 2%. So if you put your money in a savings account that gives you 3% annually, you're only beating inflation by 1%. And compound interest, like we've talked about, that is why you want to invest, because that's what's going to actually snowball and accumulate and grow your wealth. With a savings account, compound interest is not going to go far with just 1%. So that's why investing is important, and that's specifically in the stock market, because that is where you're going to earn more than the average savings account. And the reason why we put money or invest our money in the stock market, well, it's a proven way. All the wealthy people do it. and it's an accessible way. Most people, who have a lot of money, they'll try and put their money in private companies or real estate or, invest into businesses so that they can grow with the business's success. But for just regular schmegular people, the most accessible way is to do that in the stock market. I know investing can sound scary. I have been there once back when I first started. But I truly believe investing is a life skill. It is something that you do need to invest your time in to understand. And the earlier you get that done, the more time you have in the market. Therefore, your wealth is growing faster and bigger. So that goes into our next section. How does the stock market actually work? Think of it as like a giant marketplace. You are buying and selling companies that are publicly listed. So not all your favorite brands are going to be publicly listed. Some are privately listed. But as a publicly trading company, you as a retail investor, you're able to buy and sell a piece of a company. And these are called stocks. And the price of each stock goes up and down based on how the company is performing, how people feel about them, just so many factors. So when you invest your money into a piece of a company, you are technically betting. I don't really want to say that, but you're technically believing that this company is also going to grow. And with that time, you will get a piece of that growth. You can buy companies that are worth a lot of money in them. These are called high capitalization stocks. Examples of these are like Apple, Microsoft, Meta. So investing pretty much lets us participate in the success of these businesses. Like imagine buying Apple when it first started. Yes, it's speculative because who knew it was going to grow this much, but now it's a blue chip company. And a blue chip company just means that it's an established company with a lot of money in it. And it has a reputation of being reliable and it's able to operate profitably. What is now a stock or an ETF? So a stock, like mentioned earlier, is a piece of a company that you can buy. So if you own the stock of the company Apple, you have a small little sliver that you're owning of the company Apple. Now an ETF, this is called exchange traded funds, and an ETF is just pretty much a collection of all these companies. That way you're not putting your money into just one company. So in this case, Apple, you can put it into multiple companies, but you don't actually have to actively go out and buy each individual company. You just have to buy the one ETF and it contains all these companies for you. The reason why ETFs are popular is because you have an investment firm that manages the ETF for you and you are just able to buy how they organized it itself. So different ETFs have different compositions of certain stocks based on how they believe it's going to beat the stock market itself. You'll find ones with a high tech category, a high financial category, or companies that are so big so they'll try and lower the percentage of it, or maybe some companies that have high capitalization and they want to put all those companies in. So a variety of different ETFs, but you as a retail investor have the option to buy individual companies or an ETF that contains multiple individual companies. There are also ETFs known as index ETFs or index funds. And technically you are just buying what the stock market has already organized. So if you go into Yahoo Finance, if you go into, whatever stock market website, the first thing you'll see are these charts. And these are charts that look over what the stock market has already organized. So some of these are the 500 largest companies in the US, 100 of the largest companies that don't include the financial sector, 30 prominent companies, or if you're in Canada, you'll look at the 60 most top largest companies in Canada, the Russell 2000 index. So all these are indices. Indices are pretty much benchmarks that the stock market relies upon. So there's a bunch of ones that you can look into, and you'll find investment firms also having their own ETFs that track the S&P 500. Now, who are the investment firms that manage different ETFs and manage ETFs that track the index? So some of these examples include Vanguard, probably one of the oldest investment firms in the world. You also have BlackRock. You also have BMO. So each investment firm has their own ETF that tracks an index. So Vanguard has their own S&P 500, which is called VOO, and this is the ticker symbol. A ticker symbol is just the abbreviation code that you can use to look up on a stock market website. Vanguard is a US investment firm, so you'll find VOO, but there's also a Canadian version where they buy VOO, and this one is called VFV, and this is in a Canadian dollar currency. Although you are able to buy VOO as a Canadian investor, when you're starting, I would personally want to buy Canadian dollar stocks and ETFs. That way you don't have to worry about the currency exchange. There's also one by BlackRock, which is called XUS, and then there's one by BMO, which is called ZSP. You as a retail investor, you have many options, but how do you decide which one is best for you? So for me, there's 5 parameters that I look at when you compare different ETFs. The first one is MER. This is called the management expense ratio. This is a fee and it's represented as a percentage, and you want to look at this to see how much of your investment or your money that you put into this ETF is being taken out by the investment firm to organize it, manage it. This is a parameter that I want to look at to compare, do I really want to be paying this much in fees? The other one is assets under management. This is how much money is actually being managed or how much money is invested into this ETF. So the more money that there is in an ETF, I personally like to see it as a little more reliable, a little more stable. Next one is inception date. This is the date that the ETF first started actually publicly being able to have retail investors buy and sell. And I like to look at this because then it tells you how long this ETF has been running. Next is hedged versus not hedged. So this is a harder concept to understand, but it is important because VFE is just buying VOO and it is buying it in US dollar. You as a retail investor, you are also affected by the currency fluctuation between CAD to USD. If you don't want to partake in that, there is one that's just called hedged. You can buy one that the currency is just stagnant, so you don't get affected by the currency fluctuation. So there are 2 types. And the last one is the performance actually against the actual benchmark. So if you go into the ETF fact sheet, which this is the sheet that'll tell you every single thing that you need to know about the ETF, you'll be able to find a chart that actually compares it to the S&P 500, in this case, the benchmark that we're going to refer to, and you'll be able to see the overlap between the ETF or the index ETF versus the actual benchmark. So I like to look at this as well, just so that I know that the investment firm is actually replicating the exact index. Now that you know a little bit more about the stock market, a little bit more about stocks and ETFs, how do you actually invest? So if you're a student, I would personally start off with the TFSA. This is called the tax-free savings account. And this account allows you to put your money into the account, and when you buy a certain stock or ETF and it grows and you earn a profit, that profit is not taxed. Usually when you make money in Canada, all of the earnings that you make are taxed and you have to report it as income. But in this account specifically, when you earn or make money from your money growing, it's not taxed. And the tax-free savings account, I think, is the most flexible because there aren't a lot of rules to it compared to the other registered accounts. If you don't have a long-term goal that you've set for yourself, then I think this is probably the best. The other one is an RSP, and this one's specifically made for retirement. So there's a little bit more rules to it compared to a TFSA. One is it's a tax deferred account. So different to the TFSA where it's not taxed at all. The RSP, you're deferring the tax. So you still have to pay the tax, but you pay this tax when you withdraw at retirement. So the idea is you are putting your money into the RSP when you're making a lot and your tax bracket is high. But then when you're retiring, the idea is you'll be in a lower tax bracket. So when you withdraw, you'll actually be saving money. The other one is the FHSA is a new account that opened up in April of 2023. This one is made specifically if you are looking to buy a home in the next 15 years. 15 is the number of years I say because that is how long you can keep the account open before it transfers over into the RRSP. So a lot more rules to it. Maybe I can make a video specifically detailing each registered account. But if you're new, I would probably just start with the TFSA because it's just the most easiest one to understand, in my opinion. Next, you're going to have to pick a platform. So my favorite is Wealthsimple. This one is the one that I started with when I first started investing 7 years ago. There's also Questrade. I also really like Questrade as well, but I think Wealthsimple is just cleaner to look at, easier to navigate. So this is the one that I would use. I have a link in my bio if you want to start with $25, or you can also just go with your bank. Each Big Five bank has their own self-directed investing apps. The only downside to banks is they're not commission free. RBC has actually changed and they're now commission free, but the other ones, they'll have certain caps such as 30 free trades, and then the rest you have to pay like $5 to $10 for each time you buy or sell. Now, we're gonna go through how to buy on Wealthsimple. So you're gonna click the link, enter your email, download the app. You're going to sign up, register, and make an account. Once you finish that process, putting all your information in, your SIN number is also going to be required. You're going to open up a tax-free savings account and click stocks, ETFs. This is the one where you can self-buy and sell stocks. The other one is a managed portfolio, and this is one where Wealthsimple manages your money for you. It'll just ask you which risk level, and they have 4 from aggressive to conservative. Once you make an account, you'll now have a TFSA. You're going to go into this little button right here, type in the ticker symbol. So in this case, we'll type in VFE, and you'll click the first one that shows up. This is the one that tracks the S&P 500, and you're going to select buy. Once you select buy, there are 2 types. One is market buy and the other one is limit buy. And there's also other ones, but these are the 2 main ones. Market buy is when you buy a stock at market open hours, and it'll allow you to buy it at that specific moment's price. Limit buy is buying it when you want to set a certain price for it. This is more handy if you're buying individual stocks and you're trading, because you want to buy it when the price is fluctuating quite a bit. Usually I just buy market buy because I will buy it when the market is open. In Pacific Standard Time, that is from 6:30 a.m. to 1 p.m. And then you're just going to start off with ETFs. There are tons of ETFs that you can look into, ones that we've mentioned earlier that just track the indices. Then you're going to press buy. You can select either the max, which will allow you to buy shares equivalent to how much money that you already have, or you can just select the number of shares you want to buy. So for 1 share, it'll cost you this much. And if you don't have enough, you can also buy fractional shares, which is just a portion of just one. So if you're planning on buying individual companies, you have to research into them, look into financial reports. Aritzia is a Canadian company that has been doing really well. So if you want to look at their financial report, this is kind of what it looks like. It's a very long PDF with a bunch of numbers, revenue, cash flow, how they're managing their inventory, etc. And this is something that you want to see as an investor to see what is the potential of this business. And if you don't have time for that, I used to when I was younger because I thought it was really fun, really interesting. And if you're someone like that, you can definitely do that, but I wouldn't put all of my money into it unless if you're a super serious single stock investor. Otherwise, ETFs, it's already diversified for you. There's so many companies that you are putting your money into, and you don't have to actually do the heavy research. We're going to build a consistent routine. Now that you know how to invest, now that you know what the stock market is, and now that you understand the importance of it, building a consistent, disciplined routine is where you're going to really see the results. So just because it's a small amount doesn't mean you shouldn't invest. I personally think even if you just have $10, if you can do that monthly, that habit that you are building is what's going to set you apart from other people. Compared to if you're like, oh, I have a lump sum of money, let's just invest it. That's great too. This is called lump sum investing. I think developing this habit and practicing and understanding the value of putting even just a little bit aside, even if the bills are tight, even if your income is a little bit struggling this month, even just putting a little bit aside to invest, I think is so, so important. So using an investing calculator, let's see how much this actually compounds and grows if we put our money into the stock market, and the stock market averages between 7 to 10% annually. My favorite investing calculator is called the Calculator Site, and the reason for that is because you can see each year how much the balance is, what the interest is, and how much the interest is compounding towards the next year. So $100, you started off with 0. Let's put the rate at 7%, and for 20 years, this is how much is going to be at 20 years just from you putting $100 each month. Obviously, if you put more in, you're going to see a greater value. The earlier you start, the longer you have time in the market, which will then compound even more. So that is why starting early is important. And if you think you're old and you are too late, it's not. It is not. Starting is the most important thing. The fact that you are trying to start is, I think, such a huge achievement already. If you have made it through the entire video, congratulations to you, because now you're on your way to achieve financial freedom. And investing is the tool that's going to get you there. So I wish you all the best and luck. If you have any questions, please leave them below. I'm more than happy to help. Make sure you like this video, subscribe, and I'm hoping to upload more. If you have more video suggestions, definitely leave them below. I'm also on TikTok and Instagram, so make sure you follow me there. I'll see you guys in the next video. Bye.